Thank you again to the Mining Journal for having us here. I guess the reason for this panel is the world has changed. There's sort of a new normal in financing and project financing. And really what it is a reduction in the importance of equity. And just to quickly give you some quick statistics on what's going on in the space. If you look at all the financings that were done for mining companies on the TSXV last year, about 50% of that money came from sort of strategic investors, whether that's PE, other corporations, or royalty companies. And then if you look even more in the sort of the last few days, this isn't something that's restricted to juniors or new mine builds. Obviously, Cobalt 27 has helped finance, and Justin's company has helped finance the expansion of Voisey's Bay, which is through a cobalt stream. Obviously, the last few single asset developers that have been put into production have all essentially been financed through strategic money. You look at Hope Bay for TMAC, Bruce Jack for Pretium, Fruta del Norte with Lundin, and Pumpkin Hollow for Nevada Copper. And those assets you're seeing are primarily funded out of PE, like Orion, or royalty companies like Paul and Justin represent. And then most recently, and what is a bit of a new wrinkle, just last week, Orion announced that they are taking a development stage company private by acquiring Dalradian Resources for just north of $500 million in total equity value. So it's an interesting, the landscape has dramatically changed because this isn't typically a stage you'd see something more normal PE would do as opposed to those involved in the mining space. So we're at this interesting juncture, and sort of, as I've said, the world's sort of changed, and this alternative financing has cropped up, and obviously why we're having this panel. Maybe we'll work down the board, but we'll start with, I guess, how do we get to where we are with this new normal? What happened? And maybe we'll start with you, Michael, and work our way over.
Well, afternoon, everybody. I think it's a convergence of factors. I think firstly, the equity markets have been challenging over recent years. Post-GFC, there was a little resurgence, but then there's been a long tail off there. So for projects trying to raise capital, for companies trying to raise capital, there's been a challenging equity environment. And that's coincided, unfortunately, in some respects, fortunately for me, but unfortunately for the sector, and perhaps, bank finance has also been retreating exactly the same time for somewhat similar reasons. In that, post GFC, there was a focus back on the balance sheet, but also tighter banking regulation as well, and a realization perhaps that some, not all, those here don't include, of course, but some of the banks had sort of overstepped the mark in terms of what they were prepared to lend to mining companies. Those two things sort of converged and created a gap that it wasn't that difficult, to be perfectly honest, for companies like Orion and like these guys as well, to perhaps somewhat different degrees, to step into and fill that void. So it was really a pull into the sector. I think I would be lying if I said that at Orion we set off with this grand vision to try and carve out this niche in the middle here. It wasn't really. We were busy doing certain kinds of innovative financing, perhaps, but then the sort of landscape really did open up for us.
Paul, anything else you want to add to that on why we're here?
Sure, and I think there are a combination of things there, and the one is just the normal cycle that you have in commodities. We've been through a great boom, and then you go through a down cycle, and you get capital moving out of the sector. I think that's a natural development and plays out again and again. I think what Michael points out is there are a couple of things that happen on top of that, and the one is on the equity side. So much of mining funds now going into passive hands that's exacerbated the retraction of equity from the market. And probably on the debt side, it was also just the Basel Accord and the capital requirements for project financing. So I think there are a couple of particular developments that have exacerbated it through this cycle.
I guess, Justin, for you, do you view this change as cyclical, or do you think it's permanent?
Yeah, I'd say it's certainly a permanent change. If you look at Franco-Nevada, it's been around in its previous iterations for 35 years. If you look at the streaming space as a whole, Silver Wheaton was spun out of Goldcorp back in 2006, so that company's been around now for 12 years. It's a $40 billion sector in Canada now, just the royalty and streaming space in the public markets. That doesn't include guys like Orion. So I think it's here to stay. I also think, going back to the previous question, when you think about the retrenchment of both the debt and the equity markets, at the same time you had Silver Wheaton come to market and all of a sudden raise a significant amount of capital, and that sort of formation of this royalty and streaming sector just happened at the same time as really you did have this retrenchment as investors have focused on diversifying their capital away from single asset mining companies. So I certainly think it's here to stay, and there's a renewed focus on cost of capital, and really the game that we play, certainly in the royalty and streaming business, is a cost of capital game, which is we offer a lower cost of capital relative to many other sources of capital, and that's why this business has really proliferated.
Okay. Well, each of you represent a slightly different take on alternative finance. So maybe we'll just give each of you a couple minutes to talk about your business model, and we'll move left to right just to make things simple. You go first there, Michael.
Yeah, maybe just before I do, just on your last question, sorry, just to go back, but I think that the question here is it the new normal sort of sums it up, and I think it is, and is it going to change? Is it going to go away? I think it's worth making the point that mining is a very unique sector, and so what has been the norm for mining isn't necessarily the norm for other sectors. So I think the position we're in and finding ourselves now in mining should not be considered novel. It's actually in many respects just the mining sector becoming more normal like other industrial sectors. So I don't think we should necessarily think that this is shocking, these things that are happening. The inflow of private capital into mining is fairly new, but it's perfectly common in other sectors, and indeed we're a long way behind where many other sectors are in terms of the prevalence of these kind of structures and products. So that tells me that there's a space, and it's taken a long time for it to take root, but it's here to stay. Sorry, and then to answer your actual question.
Well, I guess I think that's directly reflected in the go private of taking Dalradian private. That's a normal thing in every other sector, but not something you typically see in mining. But maybe tell us a little bit about Orion, what you guys are doing.
So Orion, I mean, we started out as a let's call it a spin out from a trading company. So originally the idea was that we would provide product to the trading arm of the business, the commodities trading arm of the business. That business grew through the good work of the people who were there at the time. I wasn't there, but the good work of those people, and almost grew as large as a trading business. And so that became apparent that there was actually a sustainable business model there on its own without the trading business. That's where Orion came from. And Orion realized that it could just provide, let's call it packaged financing solutions that were tailored to particular opportunities. So they weren't cookie cutter, if you will. They were matched to the circumstances of that company. And that was a fairly a powerful offering. I think there was initially a strong perception that was expensive financing. I think we have done an awful lot of work to illustrate to the counterparts we speak to that isn't necessarily the case, and that if you actually take into account all of the other elements of a financing package from Orion versus somebody else, it's actually very comparable with where everybody else is. We're just dealing with it in a different way. That took some time to sort of take root, and I wouldn't say that education process is not complete yet. But that is gradually taking root. And I think what we've seen recently is that further expands so that we're now just focusing on, we're now not just focusing rather on construction finance projects, but we're focusing instead on whatever people want us to focus. So people come and talk to me and say, I would like to do this. And I say, great, let's try and work out how we can do this and try and offer a solution to them. And that is what's seen as move into acquisition financings and indeed ultimately acquisitions outright, such as Dalradian that you refer to. So yeah, I mean, we have the ability to do all of those different things. And I think we'll continue to expand the scope perhaps of what we do.
Great. Paul?
Yeah, our business has evolved. Many will know Franco started off as a royalty company, and then as the streaming business has evolved, that we've grown into that. And so happy to participate both in terms of royalties and streams in financing companies. A lot of that ends up being building new projects. Our biggest commitment is helping to First Quantum to build Cobre Panama. We're providing just short of 1.4 billion of what's about a $6 billion build. So play at the large end of the spectrum, but have also been active at the small end of the spectrum, and that is financing gold companies. A good example is Karma. Justin and I actually worked on that together a few years ago. Gold mine in Burkina Faso, also Teranga, another one in West Africa, Klondike, so smaller gold mining companies that are building assets or acquiring assets. So participate at both ends of those spectrums. And in particular, what we like to bring to the table is, we think, the lowest cost and most flexible form of financing. And I put the "and" in there because obviously the most flexible form of financing is equity. But depending on when you raise it, not necessarily the lowest cost. So we have tracked all the companies that we've financed in terms of stream transactions, whether they're gold companies or whether they're base metal companies with a precious metal credit, and are proud to say that all of those companies have outperformed their peers in a couple of years after we've done those.
And Justin?
Yeah, so we took the precious metals, precious metal royalty and streaming business model, and we took it into cobalt. We launched the company about a year ago, just over a year ago, and have raised $800 million in the last 12 months to build out not only a physical inventory position of cobalt, which today sits around $350 million, but also to build out a streaming and royalty portfolio, including what Derek mentioned. We just announced a $300 million US investment to expand Voisey's Bay in Newfoundland to go underground. We did that in conjunction with Wheaton Precious, who did a concurrent $390 million stream on that project, and that was a 75% cobalt stream to help fund the $2 billion underground expansion of Voisey's Bay. So really taking this $40 billion sector in precious metals, applying it to cobalt, where we actually think the model works just as well in cobalt, because cobalt is a byproduct of nickel and copper production.
It's interesting that both for the royalties and streamers, you're working both ends of the spectrum as far as small and large scale companies. Moving on, I guess, to the next step. Obviously, when you're looking at alternative finance, the due diligence and the process of actually making a decision on investment is a little bit different than sort of let's call it the range of your traditional equity investor to your traditional bank lender. Maybe each of you talk about the due diligence process that you guys work through to get to make a decision. Well, we'll start at the other end.
Yeah, sure.
Justin.
So what you'll see in royalty and streaming companies, and Cobalt 27 is no exception, is we don't have a large staff ourselves. I think we've got 5 full-time employees. So when we go out and evaluate projects, we hire a team of consultants that help us. So we'd hire a mining consultant, we'd hire a resource consultant, we'd hire a process engineer, along with, in some cases, an environmental and social consulting firm to help go to the project, look at the key risks of the project, look at the resource base. Of course, we're looking for projects that have good exploration upside, which we'll talk about a bit later. But they help us evaluate those red flag risks, if you will, and help us create what we do when we model it out an opportunity is create really 5 different scenarios. So everything from an upside case to a downside case. Try to ascribe a probability to each of those cases and present that information, of course, to our board and our technical committees. Try and make an informed investment decision. But I think the difference between what you'll see us and the equity investors do, of course, is we spend that time and that energy and a lot of money hiring consultants and going out to the project, conducting site visits, spending, that due diligence process would generally take us 2 to 4 weeks, depending on the project. But we spend a lot of time and making sure that we're picking the right projects to invest in. And that gives us, we think, a leg up in choosing those right projects to invest in. And as Paul mentioned, Franco and the royalty companies in general have a very good track record of doing exactly that.
Maybe the same question for you, Paul, with a slightly different twist, because obviously you make sizable equity investments as well. Is there a different process on the small end of the scale versus the large end of the scale?
I'd say my overall comment is, if you contrast what we do, really all of us, compared with the typical equity investor, The main difference is we do due diligence. Sometimes people, you often get the comment to say, my God, that's a fantastic business model, royalty or streaming, compared with the returns that you've seen in the equity sector, and they are good instruments. But I think as much of that difference is just investors that have the ability to do due diligence and investors that don't. So just the pure fact that we're doing it, I think, is a huge differentiator. And I think, as you see with players like Michael, if you have that ability to do due diligence, then once you understand the asset and what the capability is, whether you're doing debt or equity or streaming, at least you know what you're getting.
And then for you, Michael, maybe a slight variation. What are some of the key things that you look for when you make an investment decision? Probably key things you look for and key things you look to not see.
Focus on due diligence, you mean?
Yeah.
Firstly, I'd concur with Paul's comments. It's probably not fair to contrast what we do with a typical, certainly a small-scale equity investor, because we do have the opportunity, when you're providing a large part of the financing, to be able to do that full due diligence. So I would compare what we're doing to the banks more than your average equity investor. In terms of what we're looking for, I think the first thing to say is, compared to traditional bank financing, that we won't be accepting corners to be cut. That, again, when alternative finance first emerged on the scene, there was an assumption that we would not require full environmental and social studies. We wouldn't require companies to adhere to equator principles and the like. That's just not true. We have the same standards as the banks. So we are expecting things to be well covered, appropriately studied, as in accordance with the stage of development of the project, of course, and no sort of disciplines left unturned. Geotech being the one that seems to be always left out, for example. So we're looking for a comprehensive set of studies. We're looking for a complete set of studies. I think the difference, perhaps, between ourselves and the traditional banks is, obviously, we are capable of moving a lot quicker. That's actually no reflection at all on the banks. It's more a function of the fact that we're only set up to be conducting, we're a deal shop, we're only set up to be conducting due diligence on mining stage development companies, development stage mining companies, rather. And our investment committee and the people that are looking at the due diligence we've done and approving investments are either, like myself, drawn from the team, partners of the organisation, or even our independents on our investment committee are people who are drawn from the mining sector. So we know what we're looking at, and consequently we don't look for our technical consultants to write voluminous reports around what is mining. We're just looking for them to tell us what the issues are. I've told technical consultants before, I don't need to report to anyone here, so just give me a list of the issues. Exaggerating slightly, but that's all we actually care about are the issues. So that's what we're looking for, but there's no corners to be cut, other than if there are things where your project, if you're trying to develop your project and you've not had time or you've not had access or whatever it may be to a certain piece of work or a certain study, just tell us up front and we will try and work with you to accommodate that, but without delaying your project. We'll try and work with you.
And I guess you've all mentioned it relative to traditional equity investors. Obviously, we have several in the room here, and this is probably an interesting question. How do you think traditional equity investors should look at it when one of your companies is stepping into a financing? Should they view that as slightly de-risked? Because obviously you have access to information that they typically don't. You have information asymmetry, but also your return models are slightly different than the equity investor. I'll let you try and handle that one first, Paul, and then see if the other guys want to add to it.
Yeah, well, maybe the starting point on that is, again, when you look at the sector, and a lot has been made about how badly the sector's performed over the last number of years, and some of that has been cost inflation, some of that has been deals done at the wrong point in the cycle, but probably one of the biggest contributors to that performance is capital structure. And it's an industry where so often what we do is add too much financial leverage on top of highly volatile commodities in the first place. So the first thing I'd say as an equity investor is don't just look at the assets that you're investing in, but look at the capital structure and say, once we've cleared the burden of the debt and potentially a stream of royalty, how much is left for the equity investor? And I say all of that with a purpose, and it is that often we are competing against debt as a provider of capital, and what we're trying to provide is a smaller burden on the asset, a much more flexible burden on the asset, and something that plays out over a far longer time frame than what often is debt that can be a very concentrated and high bar to clear in an environment where commodities can easily move in directions. So it obviously depends on what investment gets put in place, what the burden on the asset is, what's left for the equity holder. But I think very often what we bring to the table is a much more sustainable capital structure that is better for the equity investor.
Justin, you have any further?
Yeah, I would say if you looked at, to add to Paul's comments, if you looked at the history of streaming deals that have been announced, the vast majority of them would have both the streaming company and the mining company, which they financed, their share price reacting positively on the day of announcement. And there's certainly a third-party verification that's part of that story, which is Franco or Wheaton Precious or ourselves at Cobalt 27 have spent the time and the energy to do due diligence on those projects, and we're putting our stamp of approval on those projects, and in a lot of cases removing a significant financing hole that would be in place and certainly could remove some of that financing overhang on the project. But the first stream by way of example, the first stream we announced at Cobalt 27 was with a company called Highlands Pacific in Australia, which has a minority interest in a project called Ramu in Papua New Guinea. The day that we announced that financing, which was a $113 million financing for Highlands Pacific, the stock was up 65% on the day of announcement. And that really was us coming in as streaming investors, replacing debt that they had on the balance sheet, replacing that debt with the stream being over now a 30, 40, 50-year period instead of debt that was over a 4 or 5 year period, and the stock price almost doubled. So, there is that certainly the positive element of moving that overhang, but that third-party validation.
Michael, obviously your model's a little bit different. You can end up everywhere in the capital structure, so maybe your comments on that.
Yeah, I mean, I think in terms of what an equity investor should see when they come in or perceive when they come into an investment or are in an investment that we have made an investment in, I think, yes, the positives are, firstly, we will have done thorough due diligence, which we hope is of decent quality. Secondly, we will have endeavoured to structure that investment to match the project. It won't just be a box forced onto the project. It will be tailored to match the development profile and the cash flows of that company, and consequently try and make it as manageable as possible. And thirdly, just as an institution, Orion is a friendly lender, and that's not to say that many banks are unfriendly lenders, but we have to be, because we're also usually in the equity. And I can assure you that if we lose our equity in an investment, we don't make it back on the debt piece. So we need to make a good return on the equity that we've invested. So our intent is good, if you will. We have a good alignment with you, and it's the main reason that we try and make those equity elements to our investment, as well as obviously bolstering our returns. Sometimes there is an agency challenge as with all management teams versus shareholders, in that management teams are not necessarily always incentivized perfectly to align with their shareholders. And management teams sometimes have a different impression of what their shareholders want than what they actually want. So we have been steered into situations, if we're brutally honest, where we have been saying, "Are you sure you want to go down this route? We'll do it. We don't feel exposed, but it may not be the best solution for your shareholders. How about this instead?" We have been in those situations, and we have tried to guide companies. But if management teams want to do transactions with different priorities than we have, then it doesn't mean we won't still do them. And they may not be as good solutions for shareholders as they could have had. I'm not saying they're bad solutions. They'll get their project financed with all of the positives that I've said before. But sometimes the question is, do management teams fully understand what they're taking on? And the answer is sometimes no, which is why I think it makes sense that, this is a specialist area of finance. It always makes sense for a management team to hire a good advisor who knows what they're doing, and to use them appropriately. not for competitive tension or anything like that. That's gone. Instead, to focus on making sure that the structure is optimized for their situation, so that they ensure that the value is there for shareholders.
Great. I think that was it's an interesting perspective for the sort of the equity investors in the room. So maybe moving back to the macro, we've talked about alternative finance and where it is and where it's going and how equity investors should view it. Maybe let's move back up to a higher level. Where do we see the equity market or the alternative finance market evolving to? Maybe we'll start down at the end with Justin. Justin, do you see more or fewer streaming and royalty companies? And do you see, and what size do you think that they're gonna occur at? Because obviously there's everybody from Paul at Franco to much smaller end of the scale in the 20 to 30 million.
Yeah, it's a great question. I've been in the streaming space myself for 12 years, and I can say in that time period, I've seen many streaming and royalty companies start. I've seen many try to start and not get off the ground, and I don't see that going away. I see, people see the attractive returns and the attractiveness of the business model. So whether it's streaming and royalty companies or just other forms of alternative financing companies, I think there will continue to be a number of these that pop up in various forms. Even within what we've done in the cobalt space, you've now seen a new royalty or streaming-like fund in the uranium space start up in Europe, and that's called Yellowcake. And so people have seen that you can now take what has worked in the precious metal space and take it into other commodities, and I think that's going to continue, and may lead to some consolidation of the sector as well, which we have seen in the past 10 to 15 years. But certainly, I think there'll be.
And I guess for you, Paul, a slight variation on that question. Obviously, this is a very competitive space in the precious metal sector as far as acquiring royalties. Do you think that's going to that's providing a natural limitation for new players coming in?
Yeah, well, I'd start off and maybe go a bit back in history with Franco. So we're in a sense the second iteration of Franco, and the first iteration started in the mid '80s and ran through to 2001 when Franco was acquired by Newmont. But part of the interest in Franco in agreeing to that transaction was there was very little going on at the industry, very little happening in the industry at the time, and for the royalty and the streaming model. You do need that there's capital available to the industry, that people are building projects, people are exploring for projects, so that optionality that you hope for can come alive. So you do need a sector where capital is available for the sector for royalty and streaming companies really to prosper. And so I'd say the first thing is, for us to continue growing in our sector, we need to get back to the phase where there is capital and when people are building new projects. I think that the sector is doing a great job at showing constraint. I think that'll sow the seeds for the next growth cycle. But I really think in order to support more royalty and streaming companies, we really do need that capital spending cycle to allow it to happen.
And sorry, just to follow up to that, is that part of the reason that you guys have shifted down, looking at earlier stage royalties now, because you can help provide that next set of projects, if you will?
It's a combination. If there's a shift in terms of our strategy at the moment, it's maybe more in terms of diversification. We, in the last couple of years, have spent more of our capital in the oil and gas sector, and that just has been, it's a sector where a lot of capital has pulled out of the sector, so we're seeing good opportunities. It's also obviously a very large sector compared with the gold sector, so when things have been a bit quieter in the gold sector, it's been a great avenue for us to continue to grow the company.
And then I guess certainly a variation on the question for you, Michael. Obviously, there are a few PE players that are your competitors. Do you see that sector growing as you guys have success and others have success, that there'll be more PE firms? Because obviously there's a technical challenge as well, a technical hurdle.
That's a good question. We're not necessarily seeing any particular competition at the moment. And that's not a function of the people who are out there and the other people going into the space. It's more a function of the there's a large number of projects, there's a large number of opportunities, so there's no need to compete, rather than it being the capabilities of the people who are coming in, many of whom are very good, and in actual fact we look to partner with those groups rather than compete with them. So I anticipate that we will continue to expand the groups, the range of groups that we partner with. Orion is not an organization that wants to have it all for itself. We're happy to work with anybody so long as it's compatible. We've certainly talked with many things with Justin before about working with him on things. So there's plenty of scope to do that. And I think that's because really Orion is moving into a slightly different space, which again, coming back to the title, is it the new normal? We're moving into this sector point now where really we're a source of capital for the sector. It may be deemed an alternative source or a new source, but really it's not. We can try and solve the need that people have. So what we encourage is people to just come and talk to us and say, here's what I want to do. Can you help us out? And that can be mine management teams or mining management teams. That can be fellow shareholders. That can be fellow debt holders. That can be other people looking to finance a project but want to partner on it. And really we're getting a whole load of deal flow from those latter groups rather than just the former. And what we're trying to do is say, yeah, come and talk to us, and we'll try and come up with our best solution, and we'll tell you very quickly if we can't. So in many respects, we're going back to an old normal, which is the old, perhaps the merchant banking model that people may remember. The Rothschilds did, once upon a time had a very good practice doing this. And, I think we're in some respects going back to that, where people come to us, we'll talk to you, and we'll give you the best solution we can. Doesn't mean it's the best solution you can get, by the way. Different projects, different situations. We're going to be better off doing a deal with Franco, going to be better off doing a deal with SocGen, who I saw here earlier. Doesn't mean we're always the right solution. We'll just give you our best solution and then try and work that out with you. So I think we're going back to that sort of solution where we become just one source of finance for the sector. And part of that is where gradually, as people may have seen if they look at what we're doing, we started off in base and precious metals, and we're gradually expanding with different products and different offerings into different commodities. Great.
This is very interesting. We have a few minutes left, and I am going to try and save a couple of those minutes, but I would like to take a couple of questions from the audience, if possible. We got one
here. Over the last 30 years, the royalty financiers have really picked up quite a lot of market share, which has been lost by banks and brokers and traditional equity finance. If we're looking forward over the next 20 years, there's a lot of projects that are going to need to be financed, but the risk level is surely going to be higher. Isn't one of the boasts of the royalty companies that they've never lost a royalty yet? If we're looking forward, do we not have to be taking more geopolitical risk, or should you be supporting the equity investors that develop the projects to a level where you can actually provide finance?
I'm going to let Paul take that, because your company has the most history of the space.
Yeah, and there are a couple of things in there, and I'll try and touch on them. And the first is the tenure of royalties, and that very much is country dependent. I mean, do you have a system where royalty is recognized in the mineral tenure in Canada? The US, Australia are great countries for doing that, and it is a fantastic instrument in those cases. So for those jurisdictions, I don't think we see any risk of losing any royalties. Part of streaming, and there are many reasons that streaming has grown, but it is, how do you provide that sort of financing in countries where you don't have a system of royalties? And streaming has been a good way of doing that, but it is a contractual agreement, and so you do need to decide what sort of security you want for that agreement, and that's a negotiation between the two parties. So depending on what you negotiate, I think will determine what happens if you do have any projects that reach the point of insolvency. In terms of that relation then between your streamers and your other capital providers, I'll go back to my original comments on the capital structure in the first place. I think for equity investors to get good returns, you do need to focus on what is that capital structure. And that means we all know it is a highly cyclical sector, is setting up the companies so that you've got flexibility that you can handle downturns in the commodities. And so that's a responsibility of all the players, and probably particularly of management as they set up that capital structure to make sure that they leave enough room that the equity investors preserve their investment through the cycle.
Anyone else want to add to that? All right. Okay. And I think we'll wrap it up there and try and get us a little closer to drinks at the end of the day. So thank you very much, everybody.